Introduction to Chapter 7, Due Diligence and Negotiations. Chapter 7 delves into the critical aspects of due diligence and negotiations within the dynamic realm of commercial real estate, CRE, investments. In the pursuit of successful and profitable ventures, understanding the intricacies of due diligence and honing effective negotiation skills are paramount. This chapter aims to equip investors, professionals, and enthusiasts with the knowledge, strategies, and insights needed to navigate the complex landscape of CRE investments. The importance of due diligence. Due diligence is the meticulous process of researching, analyzing, and assessing investment opportunities before making informed decisions. It involves delving into financials, legal documentation, property conditions, market trends, and potential risks. By conducting thorough due diligence, stakeholders gain clarity about the viability of investments, uncover potential challenges, and identify opportunities for value creation. Navigating negotiations. Negotiations are central to the CRE investment process. They involve discussions and agreements on terms, conditions, and expectations between parties. Effective negotiations require a blend of communication skills, strategic thinking, and understanding the concerns and goals of all stakeholders involved. A successful negotiation results in terms that reflect the interest of all parties, creating a foundation for long-term collaboration. Creating win-win solutions. A key theme in this chapter is the importance of aligning interests and creating win-win solutions. Investors, partners, and stakeholders should collaborate to find common ground and mutual benefits. Maintaining transparent communication and addressing potential disputes proactively contribute to positive outcomes for all parties. Ensuring compliance and minimizing risks. Navigating the legal and regulatory landscape is integral to due diligence and negotiations. Ensuring compliance with laws, regulations, and contractual obligations safeguards investments and relationships. Understanding potential pitfalls and challenges helps investors anticipate risks and mitigate them effectively. Transparent communication. Transparent and open communication is a cornerstone of both due diligence and negotiations. Effective communication fosters trust, resolves issues, and establishes a strong foundation for productive collaborations. By maintaining open lines of communication, parties can navigate challenges and seize opportunities together. In the subsequent chapters of this section, we will delve deeper into the nuances of conducting due diligence, negotiating terms effectively, addressing potential disputes, and maintaining transparent communication. The insights and strategies provided will empower CRE professionals to navigate the intricacies of due diligence and negotiations with confidence and competence, ultimately leading to successful investment outcomes. What you will learn in Chapter 7, Due Diligence and Negotiations. Chapter 7 explores the pivotal aspects of due diligence and negotiations within the realm of commercial real estate, CRE, investments. This chapter aims to equip readers with comprehensive knowledge and practical strategies to excel in these critical phases of the investment process. By the end of this chapter, you will have gained a deep understanding of 1. The importance of due diligence. Discover the significance of due diligence in evaluating potential investment opportunities. Learn about the key elements and steps involved in conducting thorough research and analysis to assess the feasibility and risks associated with CRE investments. 2. Navigating negotiations. Understand the art of negotiation in CRE investments. Explore strategies for effective communication, finding common ground, and reaching mutually beneficial agreements with various stakeholders involved in the investment process. 3. Creating win-win solutions. Explore how to align interests and foster collaboration among investors, partners, and other stakeholders to create win-win solutions. Learn how transparent communication, compromise, and shared objectives contribute to successful investment outcomes. 4. Ensuring compliance and minimizing risks. Dive into the regulatory and legal aspects of due diligence and negotiations. Understand the importance of compliance with laws, regulations, and contractual obligations to protect investments and manage potential risks. 5. Transparent communication. Learn the value of transparent and open communication throughout the due diligence and negotiation phases. Explore how effective communication builds trust, resolves conflicts, and sets the stage for productive and successful partnerships. Throughout this chapter, you will gain insights into the intricacies of conducting due diligence, honing negotiation skills, and addressing potential challenges in a proactive and informed manner. The knowledge and strategies you acquire will empower you to navigate the complexities of CRE investments with confidence, maximize opportunities, and mitigate risks effectively. Chapter 7, Due Diligence and Negotiations. Chapter 7 of our comprehensive guide delves into a crucial phase of the real estate investment process, due diligence and negotiations. As Crestview Capital Holdings continues its journey to establish itself as a leading player in the commercial real estate market, this chapter provides valuable insights into the meticulous process of evaluating potential investments, conducting due diligence, and navigating negotiations with stakeholders. In this chapter, We will explore the intricate details of due diligence and negotiations, highlighting their importance in making informed investment decisions. By thoroughly understanding these processes, Crestview Capital Holdings can mitigate risks, make strategic choices, and foster fruitful collaborations. The following topics will be covered in Chapter 7. 1. Conducting comprehensive due diligence. Learn the step-by-step process of conducting thorough due diligence on potential investment opportunities. Understand how to assess property conditions, financial statements, market trends, legal documents, and other critical factors that influence investment decisions. 2. Analyzing investment risks and returns. Explore techniques for evaluating investment risks and potential returns associated with various real estate projects. Learn how to perform financial analysis, assess market conditions, and forecast potential outcomes. 3. Navigating negotiations effectively. Discover strategies for successful negotiation with property owners, partners, and stakeholders. Learn how to communicate effectively, address concerns, and achieve mutually beneficial agreements. 4. Legal considerations in negotiations. Understand the legal aspects involved in negotiations, including contract terms, legal obligations, and documentation. Gain insights into how legal considerations impact negotiation dynamics. 5. Building relationships and trust. Learn the importance of building relationships and fostering trust during negotiations. Explore how open communication and transparency contribute to successful outcomes and long-term partnerships. 6. Mitigating deal breakers. Identify potential deal breakers and explore strategies to mitigate them. Understand how to navigate challenges and find solutions that keep negotiations on track. By delving into the details of due diligence and negotiations, Crestview Capital Holdings can equip itself with the knowledge and skills needed to make informed investment decisions and secure favorable agreements. As the company navigates the intricacies of real estate deals, the insights from this chapter will be invaluable in ensuring the success of its ventures. Conducting due diligence on investment opportunities. Conducting due diligence is a critical step in the commercial real estate investment process. It involves a comprehensive examination and analysis of various aspects of an investment opportunity to assess its viability, risks, and potential returns. As Crestview Capital Holdings seeks to establish itself as a prominent player in the real estate market, mastering the art of due diligence is essential for making informed investment decisions. In this section, we will delve into the key components of conducting due diligence on investment opportunities. 1. Financial due diligence. Thoroughly examine the financial statements, projections, and historical performance of the property. Assess factors such as income, expenses, cash flow, debt obligations, and potential value appreciation. This analysis helps in evaluating the financial health of the investment. 2. Property condition assessment. Inspect the physical condition of the property, including its structural integrity, systems, and maintenance needs. This assessment helps identify any immediate repairs, long-term maintenance costs, or potential liabilities. 3. Market analysis. Analyze the local real estate market to understand supply and demand dynamics, rental rates, vacancy rates, and trends. A comprehensive market analysis provides insights into the potential for rental income and property appreciation. 4. Legal and title review. Review legal documents such as property deeds, leases, zoning regulations, and environmental reports. Ensure that there are no legal encumbrances, disputes, or restrictions that could affect the investment. 5. Environmental assessment. Evaluate the environmental condition of the property to identify any potential environmental liabilities, contamination issues, or regulatory compliance concerns. 6. Management and operations review. Assess the property management and operational practices, including tenant relations, lease agreements, and maintenance protocols. A well-managed property is more likely to generate consistent returns. 7. Exit strategy analysis. Consider potential exit strategies for the investment, such as selling the property, refinancing, or holding for the long term. Evaluate the feasibility and potential returns of each strategy. 8. Risk assessment. Identify and evaluate potential risks associated with the investment, including market fluctuations, economic downturns, regulatory changes, and unforeseen events. Develop strategies to mitigate these risks. 9. Expert consultation. Engage professionals such as real estate attorneys, appraisers, engineers, and environmental consultants to provide specialized insights during the due diligence process. Crestview Capital Holdings can leverage due diligence as a tool to make well-informed investment decisions, minimize risks, and uncover potential opportunities for value creation. By conducting thorough due diligence on investment opportunities, the company can ensure that its investments align with its strategic objectives and contribute to its success in the dynamic world of commercial real estate. Relevant examples of conducting due diligence on investment opportunities. To illustrate the importance of conducting due diligence on investment opportunities, Let's explore a couple of relevant examples that showcase how thorough evaluation can lead to successful outcomes and risk mitigation. Example 1. Office building investment. Crestview Capital Holdings is considering an investment in an office building located in a prime business district. Before proceeding, the company conducts due diligence to assess the investment's viability. 1. Financial due diligence. Crestview reviews the property's financial statements and projections. They discover consistent rental income and a history of stable cash flow, indicating a well-performing asset. 2. Market analysis. An analysis of the local office market reveals a strong demand for office space in the area, with a low vacancy rate and increasing rental rates. This suggests the potential for rental income growth. 3. Property condition assessment. Through an inspection, Crestview identifies the need for some minor repairs and upgrades. They estimate the costs and factor them into their financial projections. Example 2. Multifamily property investment. In another scenario, Crestview Capital Holdings is considering investing in a multifamily property. Due diligence uncovers critical information. 1. Legal and title review. During the legal review, Crestview discovers an ongoing dispute between the property owner and a neighboring business over a shared parking lot. This legal challenge could impact the property's value and affect future operations. 2. Environmental assessment. An environmental assessment reveals that the property was previously used for industrial purposes, raising concerns about potential soil contamination. Further investigations uncover the need for remediation, adding significant costs. 3. Management and operations review. Through tenant interviews and lease audits, Crestview identifies a history of maintenance issues and tenant complaints about responsiveness. This insight prompts Crestview to evaluate the property management company's track record and potential alternatives. These examples highlight the necessity of conducting comprehensive due diligence. In the first example, successful financials and positive market conditions indicate a favorable investment. In the second example, due diligence uncovers potential legal and environmental risks that could significantly impact the investment's success. By conducting due diligence, Crestview Capital Holdings can make informed decisions, mitigate risks, and ensure that its investments align with its strategic goals. Explanations. Conducting due diligence on investment opportunities. Due diligence is a meticulous process that involves investigating and analyzing various aspects of a potential investment opportunity in the commercial real estate sector. It is an essential step to ensure that investors and stakeholders have a comprehensive understanding of the investment's strengths, weaknesses, risks, and potential returns. Conducting due diligence is crucial for making well-informed decisions, identifying potential challenges, and ultimately maximizing the success of an investment. Here's an in-depth explanation of the key components of conducting due diligence on investment opportunities. 1. Financial due diligence. Financial due diligence involves a thorough examination of the property's financial statements, cash flow, and historical performance. This step aims to assess the property's profitability, stability, and potential for generating consistent returns. Investors analyze income sources, operating expenses, debt obligations, and projected cash flows to gauge the investment's financial health. 2. Property condition assessment. Physical due diligence involves inspecting the property's physical condition, including its structural components, systems, and overall maintenance. This assessment helps identify any immediate repair needs, potential deferred maintenance, and estimated costs for renovations or upgrades. 3. Market analysis. Market analysis involves studying the local real estate market to understand demand, supply, rental rates, vacancy rates, and trends. A comprehensive market analysis provides insights into the property's potential for rental income and capital appreciation based on its location and market conditions. 4. Legal and title review. Legal due diligence involves reviewing legal documents, including property deeds, leases, contracts, and zoning regulations. This step ensures that there are no legal encumbrances, disputes, or restrictions that could affect the property's ownership or future operations. 5. Environmental assessment. An environmental assessment evaluates the property's environmental condition, identifying potential risks and liabilities such as soil contamination, hazardous materials, or regulatory violations. Environmental due diligence is crucial for compliance with environmental laws and regulations. 6. Management and operations review. This aspect of due diligence assesses the property management practices, tenant relations, lease agreements, and operational efficiency. A well-managed property is more likely to maintain tenant satisfaction, generate consistent income, and increase its overall value. 7. Exit strategy analysis. Investors analyze potential exit strategies, such as selling the property, refinancing, or holding for the long term. By considering various exit options, investors can align their investment strategy with their long-term goals. 8. Risk assessment. Identifying and assessing the risks associated with the investment is a crucial aspect of due diligence. Investors evaluate both external and internal factors that could impact the investment's success, such as market fluctuations, economic conditions, regulatory changes, and unforeseen events. Conducting due diligence is a time-intensive process that requires collaboration among various professionals, including real estate attorneys, engineers, appraisers, and environmental consultants. By thoroughly evaluating investment opportunities through due diligence, Crestview Capital Holdings can make informed decisions, mitigate risks, and maximize the potential returns on its real estate investments. Actionable advice: conducting due diligence on investment opportunities. Conducting due diligence on investment opportunities is a critical step in ensuring the success and profitability of commercial real estate ventures. To navigate this process effectively, Crestview Capital Holdings can follow these actionable strategies. 1. Establish a due diligence checklist. Create a comprehensive checklist that outlines the specific areas of due diligence to be conducted for each investment opportunity. This checklist will serve as a roadmap, ensuring that no crucial aspect is overlooked during the evaluation process. 2. Assemble a skilled team. Gather a team of professionals with expertise in various relevant fields, such as real estate law, finance, property management, engineering, and environmental science. Their combined knowledge and insights will provide a well-rounded perspective on the investment's potential risks and rewards. 3. Define clear objectives. Clearly define the investment objectives and criteria before embarking on due diligence. Having a well-defined set of goals will help focus the due diligence efforts and facilitate more informed decision-making. 4. Allocate adequate time and resources. Allocate sufficient time and resources to conduct thorough due diligence. Rushing through this process can lead to overlooking critical issues that might impact the investment's performance. 5. Perform in-depth financial analysis. Dive deep into the property's financial statements, rent rolls, and historical financial performance. Analyze trends in revenue, expenses, and net operating income to assess the property's financial health and potential for growth. 6. Utilize technology and data analytics. Leverage technology tools and data analytics to streamline due diligence processes. Automated tools can help identify market trends, potential red flags, and anomalies in financial data. 7. Verify legal and title documentation. Work closely with legal experts to review all legal documents, including leases, contracts, and property deeds. Ensure that the property has clear title ownership and that there are no legal disputes or encumbrances. 8. Consider environmental and sustainability factors. Engage environmental consultants to assess the property for any environmental risks or issues. Additionally, evaluate the property's potential for implementing sustainable practices, which can enhance its long-term value. 9. Visit the property in person. Schedule site visits to physically inspect the property and assess its condition firsthand. This can help uncover hidden maintenance or repair issues that may not be evident from documents alone. 10. Create contingency plans. Identify potential risks and develop contingency plans to address unforeseen challenges. Having backup strategies in place can help mitigate risks and ensure a smoother investment process. 11. Engage in open communication. Maintain open and transparent communication with all stakeholders involved in the due diligence process. Regular updates and collaborative discussions can lead to more accurate assessments and faster issue resolution. 12. Seek expert opinions. If faced with complex issues or uncertainties, don't hesitate to seek advice from experts in the field. Consult experienced professionals who have dealt with similar situations before. By following these actionable strategies, Crestview Capital Holdings can enhance the due diligence process, make well-informed investment decisions, and position themselves for success in the competitive landscape of commercial real estate. Negotiating the terms of a term sheet. Negotiating the terms of a term sheet is a critical phase in the commercial real estate investment process. This stage involves aligning the interests of all parties involved, including investors, stakeholders, and the management team. Successful negotiations result in a mutually beneficial agreement that sets the foundation for the investment partnership and outlines the terms and conditions of the deal. Here's a closer look at key strategies and considerations when negotiating the terms of a term sheet. 1. Understand priorities. Before entering negotiations, ensure a clear understanding of each party's priorities and objectives. This knowledge will help tailor the negotiation process to address core concerns and reach a win-win outcome. 2. Establish common ground. Identify areas where all parties can find common ground and build on those points. Focusing on shared objectives can create a positive atmosphere for negotiations. 3. Be open to compromise. Negotiations often require compromises from all parties involved. Be prepared to give and take to achieve a balanced agreement that benefits everyone. 4. Communicate clearly. Transparent communication is key during negotiations. Clearly articulate your positions, expectations, and concerns to avoid misunderstandings and potential conflicts later. 5. Prioritize key terms. Determine which terms in the term sheet are most crucial and require special attention. Prioritize negotiations around these terms while being flexible on less critical aspects. 6. Be aware of market norms. Research industry standards and market norms for terms related to equity ownership, investor rights, management fees, and other relevant aspects. This knowledge can provide a basis for negotiation discussions. 7. Consider long-term implications. Anticipate the long-term implications of the negotiated terms. Ensure that the terms set the stage for a sustainable and successful partnership throughout the investment lifecycle. 8. Seek legal advice. Involve legal professionals who specialize in commercial real estate transactions. Their expertise can help navigate complex legal aspects and ensure that the negotiated terms are legally sound. 9. Maintain a positive tone. Approach negotiations with a positive attitude and a willingness to collaborate. A respectful and cooperative tone can foster goodwill and facilitate smoother discussions. 10. Focus on value creation. Ensure that the negotiated terms contribute to the overall value creation of the investment. Strive to structure the deal in a way that aligns incentives for all parties to maximize returns. 11. Anticipate challenges. Identify potential challenges that may arise during the investment period and address them during negotiations. Being proactive in addressing potential issues demonstrates foresight and professionalism. 12. Document agreements. As negotiations progress, document each agreed upon term to avoid confusion or misinterpretation later. These documented agreements will be crucial when formalizing the final investment terms. Negotiating the terms of a term sheet requires a combination of strategic thinking, effective communication, and a commitment to achieving a fair and equitable agreement. By following these strategies and considerations, Crestview Capital Holdings can navigate negotiations successfully and establish a solid foundation for their real estate investment ventures. Relevant examples: negotiating the terms of a term sheet. 1. Equity stake allocation. In negotiations for a commercial real estate project, an investor expresses interest in a larger equity stake due to their extensive industry experience. The negotiation process involves finding a middle ground where the investor receives a slightly larger stake while maintaining a balance that ensures other stakeholders' interests are respected. 2. Management fees and performance metrics. During negotiations, a real estate fund manager and investors discuss management fees and performance metrics. The fund manager proposes a fee structure that is competitive compared to market standards, but offers a performance-based incentive that aligns with the fund's projected returns. The negotiation focuses on fine-tuning the fee percentages and the benchmarks that trigger the performance incentives. 3. Liquidity and exit strategy. In a negotiation involving a commercial property acquisition, the buyer seeks a shorter hold period to ensure liquidity. The seller, however, prefers a longer hold period to maximize property value. The negotiation explores various scenarios, such as staggered exit options, to find a compromise that meets both parties' needs while ensuring the property's optimal value realization. 4. Investor protections and rights. During term sheet negotiations for a real estate development project, investors emphasize the importance of having a say in major decisions. The negotiation involves defining specific decisions that require investor approval and balancing the need for active participation with the management's ability to execute efficiently. 5. Financing terms and risk mitigation. In negotiations for a property acquisition, the lender and borrower discussed financing terms and risk mitigation measures. The borrower proposes a higher interest rate to secure more favorable loan terms, while the lender requests additional guarantees to mitigate potential risks. The negotiation revolves around finding an interest rate that aligns with the market and adjusting the guarantees to address the lender's concerns. 6. Environmental and sustainability provisions. In a negotiation related to a green building development, investors and the development team discuss incorporating environmental and sustainability provisions into the term sheet. The negotiation focuses on the allocation of costs for sustainable features, such as solar panels and energy-efficient systems, to ensure that both parties share the benefits and costs of these initiatives. 7. Exit penalties and contingencies. During negotiations for a joint venture between two real estate firms, the parties discuss exit penalties and contingencies. The negotiation involves determining exit penalties in the event of early termination and outlining contingencies that would allow for flexibility in case unforeseen circumstances impact the project's progress. These examples highlight the diverse scenarios and considerations that arise during negotiations for term sheets in commercial real estate. Each negotiation is unique, and the ability to find mutually beneficial solutions is key to achieving successful investment partnerships. Explanations. Negotiating the terms of a term sheet. Negotiating the terms of a term sheet is a pivotal phase in the commercial real estate investment process. It involves discussions, compromises, and agreements between various parties to establish the fundamental terms and conditions that will shape the investment partnership. Here's a detailed explanation of the key aspects involved in negotiating the terms of a term sheet. 1. Balancing interests. Negotiations aim to align the interests of investors, stakeholders, and the management team. Each party comes with its priorities and objectives. Negotiating involves finding common ground and addressing concerns to achieve a harmonious agreement that serves the interests of all parties involved. 2. Articulating positions. During negotiations, each party articulates its position on various terms outlined in the term sheet. This includes aspects such as equity ownership, voting rights, management fees, and exit strategies. Parties present their viewpoints to ensure that they are understood and considered during the negotiation process. 3. Compromise and flexibility. Negotiating involves give and take, as parties may need to make concessions to reach an agreement. Flexibility in negotiating non-essential terms can pave the way for a successful outcome. Parties should prioritize the most critical terms while being open to compromise on less essential aspects. 4. Open communication. Effective communication is fundamental in negotiations. Parties need to clearly express their intentions, concerns, and expectations. Open dialogue allows parties to address misunderstandings and collaborate towards a resolution that serves everyone's interests. 5. Strategic prioritization. Parties must strategically prioritize terms based on their significance to the investment's success. Essential terms such as ownership stakes, profit distribution, and exit strategies often require more extensive negotiations, while other terms may have a more standardized approach. 6. Legal and regulatory compliance. Negotiating term sheet terms must consider legal and regulatory requirements. Parties need to ensure that the terms align with industry regulations, securities laws, and any other legal obligations. Legal advisors may be consulted to navigate complex legal matters. 7. Documentation of agreements. As negotiations progress, parties should document the agreements reached on various terms. This documentation forms the basis for formalizing the final terms and conditions. Comprehensive documentation helps avoid disputes and misunderstandings in the future. 8. Win-win outcome. The objective of term sheet negotiations is to achieve a win-win outcome. This outcome ensures that all parties feel that their interests are represented and protected. A balanced agreement lays the foundation for a productive and successful investment partnership. 9. Long-term implications. Parties must consider the long-term implications of the negotiated terms. The negotiated terms should support the investment's goals and align incentives to ensure a sustainable partnership over the investment's lifecycle. 10. Professional involvement. Legal professionals specializing in real estate transactions often play a critical role in negotiations. Their expertise ensures that the negotiated terms adhere to legal requirements and industry standards, providing parties with confidence in the final agreement. Negotiating the terms of a term sheet requires a strategic approach, effective communication, and a commitment to achieving a mutually beneficial outcome. Clear articulation of positions, compromise, and a focus on long-term success are essential elements that contribute to the success of these negotiations. Actionable advice. Negotiating the terms of a term sheet. Negotiating the terms of a term sheet in commercial real estate is a crucial step that lays the foundation for a successful investment partnership. Here are actionable pieces of advice to navigate these negotiations effectively. 1. Prepare extensively. Thoroughly understand your own objectives and priorities as well as those of other parties involved. Research industry standards, market conditions, and precedents to support your negotiation positions. 2. Prioritize key terms. Identify the critical terms that significantly impact the investment's success, such as ownership percentages, profit distribution mechanisms, management fees, and exit strategies. Prioritize these terms for more in-depth negotiations. 3. Seek common ground. Approach negotiations with a mindset of collaboration and problem solving. Look for areas of mutual interest and seek win-win solutions that satisfy both parties' objectives. 4. Maintain open communication. Establish clear lines of communication with all parties involved. Regularly update them on progress, and address any concerns promptly. Transparent communication builds trust and reduces misunderstandings. 5. Listen actively. Pay close attention to the other party's perspectives and concerns. Active listening enables you to tailor your negotiation strategy to address their needs, increasing the likelihood of reaching an agreement. 6. Flexibility and compromise. Be prepared to make concessions on non-essential terms to achieve progress on critical matters. Demonstrating flexibility can foster goodwill and create a more conducive negotiation environment. 7. Engage expertise. Involve legal advisors and industry professionals experienced in commercial real estate negotiations. Their insights and knowledge can guide you through complex legal and industry-specific aspects of the negotiation. 8. Document agreements. As terms are agreed upon, document them clearly. This creates a record of the progress made and helps avoid misunderstandings later. These documented agreements can be valuable references in formalizing the term sheet. 9. Maintain a long-term view. Focus on crafting terms that promote a sustainable partnership over the investment's lifecycle. Avoid short-term gains that may lead to conflicts or hinder the investment's growth potential. 10. Negotiate with respect. Approach negotiations with professionalism and respect. Maintain a positive and courteous attitude, even if disagreements arise. A collaborative atmosphere can foster more productive discussions. 11. Stay patient and persistent. Negotiations can be intricate and time-consuming. Be patient, and don't rush decisions. Persistent negotiation efforts show your commitment to achieving an equitable outcome. 12. Know your walkaway points. Define your walkaway points are the terms you cannot compromise on. Understanding your limits prevents you from agreeing to terms that may be detrimental to your investment's success. 13. Review final agreements. After negotiations, review the finalized term sheet with all parties involved, including legal advisors. Ensure that the terms accurately reflect the agreements reached and align with your investment goals. 14. Cultivate relationships. Successful negotiations are often the beginning of a long-term relationship. Nurture professional relationships with the other parties, as you will likely collaborate throughout the investment's lifecycle. Effective negotiation skills and strategies are crucial in achieving a term sheet that benefits all parties and sets the stage for a successful real estate investment. By being well prepared, communicative, and collaborative, you can navigate negotiations with confidence and achieve agreements that align with your investment objectives. Common points of negotiation and potential pitfalls. Negotiating a term sheet in commercial real estate involves addressing various key points that shape the investment partnership. While striving for consensus, it's important to be aware of potential pitfalls that can arise during these negotiations. Here are common points of negotiation and potential pitfalls to watch out for. 1. Equity ownership. Negotiation point. Determining the percentage of equity ownership for each investor. Potential pitfall. Disagreements over ownership percentages can lead to impasses. Failure to strike a balance can result in an inequitable distribution of control and returns. 2. Profit distribution. Negotiation point. Defining how profits will be distributed among investors and the fund manager. Potential pitfall. Vague or unfair profit distribution mechanisms can cause disputes. If not properly defined, the distribution of returns might not align with investors' expectations. 3. Management fees. Negotiation point. Agreeing on the fees the fund manager will receive for overseeing the investment. Potential pitfall. Excessive management fees can discourage investors. Conversely, setting fees too low might impact the fund manager's ability to effectively manage the investment. 4. Investment period. Negotiation point. Establishing the time frame during which new investments can be made. Potential pitfall. A prolonged investment period might lead to investor frustration, while a too short period might limit the fund's ability to capitalize on future opportunities. 5. Exit strategy. Negotiation point. Deciding on the strategy for exiting the investment, such as sale, refinancing, or winding down the fund. Potential pitfall. Disagreements on exit strategies can lead to difficulties when it's time to realize returns. Lack of alignment can disrupt the fund's planned exit path. 6. Distributions and waterfall structures. Negotiation point. Designing how distributions are prioritized and distributed among investors. Potential pitfall. Complex waterfall structures can lead to confusion. Misunderstandings might arise if the distribution process is not clearly outlined. 7. Anti-dilution provisions. Negotiation point. Addressing how the investor's ownership stake is protected in the event of future fundraising. Potential pitfall. Overly protective anti-dilution provisions can hinder the fund's flexibility to attract new investors or raise additional capital. 8. Reporting and communication. Negotiation point. Defining the frequency and content of investor communications and reports. Potential pitfall. Inadequate communication can erode investor confidence. Insufficient or misleading reporting may damage trust and the long-term relationship. 9. Restrictions and covenants. Negotiation point. Agreeing on any restrictions or covenants that investors and the fund manager must adhere to. Potential pitfall. Overly restrictive covenants can limit the fund's ability to adapt to changing market conditions or seize new opportunities. 10. Dispute resolution. Negotiation point. Specifying how disputes will be resolved. Potential pitfall. Failing to agree on a clear dispute resolution process can lead to legal conflicts and disrupt the investment's progress. 11. Regulatory compliance. Negotiation point. Ensuring that the terms adhere to relevant legal and regulatory requirements. Potential pitfall. Ignoring regulatory compliance can lead to legal issues and financial penalties down the line. Navigating these points of negotiation and avoiding potential pitfalls requires careful consideration, transparency, and a commitment to creating a mutually beneficial investment structure. Engaging experienced legal and financial advisors can provide valuable insights and help mitigate these risks during the negotiation process. Common points of negotiation and potential pitfalls. Relevant examples. Negotiating a real estate term sheet involves addressing various aspects that can significantly impact the success of an investment. Let's explore some relevant examples of common points of negotiation and potential pitfalls. 1. Equity ownership. Example. In a multifamily residential development project, an investor with extensive experience in property management negotiates for a higher equity ownership percentage due to their expertise in ensuring high occupancy rates and tenant satisfaction. Potential pitfall. Without clear communication and agreement on equity distribution, disagreements might arise when one investor feels they deserve a larger stake based on their contributions. 2. Profit distribution. Example. A commercial office fund outlines a tiered profit distribution structure. The first tier prioritizes returning the initial investment to investors, while the subsequent tiers distribute profits based on a predefined split. Potential pitfall. If the profit distribution structure is overly complex or doesn't align with investor expectations, disputes might arise over the perceived fairness of the distribution. 3. Management fees. Example. A retail real estate fund charges a management fee based on assets under management, which is higher during the initial acquisition phase and decreases as the portfolio matures. Potential pitfall. If the management fee structure isn't transparent or is perceived as disproportionate, investors might feel that the fund manager's interests aren't aligned with theirs. 4. Investment period. Example. An industrial property fund with a focus on distressed properties negotiates a longer investment period to allow for thorough rehabilitation and repositioning before selling. Potential pitfall. If the investment period is too long, investors might seek shorter-term opportunities, while too short of a period might hinder the fund's ability to realize maximum returns. 5. Exit strategy. Example. A mixed-use development fund agrees on a clear exit strategy, stating that properties will be sold individually as they reach their optimal value rather than waiting for the entire portfolio to mature. Potential pitfall. If exit strategies aren't clearly defined, investors might question the fund's ability to generate returns on schedule or capitalize on market trends. 6. Distributions and waterfall structures. Example. A real estate investment trust, REIT, structures its distribution as a 3-tier waterfall. The first tier ensures investors recoup their initial investment, followed by a share of profits, and then additional distributions to reward long-term investors. Potential pitfall. If the distribution waterfall structure is overly complicated, investors might struggle to understand their potential returns and rights to distributions. 7. Anti-dilution provisions. Example. A technology-focused real estate fund includes anti-dilution provisions that protect early investors from being excessively diluted when new investors join subsequent rounds. Potential pitfall. Overly protective anti-dilution provisions might discourage new investors from participating, limiting the fund's ability to raise additional capital for growth. 8. Reporting and communication. Example. A hospitality fund commits to monthly reports including occupancy rates, revenue per available room, RevPAR, and detailed budget analysis to keep investors informed about the performance of hotel assets. Potential pitfall. Inadequate reporting or inconsistent communication can lead to investor uncertainty and concerns about the fund's performance. 9. Restrictions and covenants. Example. A conservation-focused fund sets restrictions on property development to align with environmental preservation goals, requiring properties to maintain a certain percentage of national habitat. Potential pitfall. Overly restrictive governance might limit the fund's ability to adapt to market changes or take advantage of new opportunities, potentially hindering returns. 10. Dispute resolution. Example. A retail fund specifies that disputes will be resolved through arbitration by a neutral third party with expertise in real estate investment. Potential pitfall. Failing to define a dispute resolution mechanism can result in costly legal battles or impede decision-making in case of conflicts. 11. Regulatory compliance. Example. A cross-border real estate fund includes provisions to ensure compliance with both local and international regulatory requirements, accounting for varying legal frameworks. Potential pitfall. Ignoring regulatory compliance can lead to unexpected legal challenges or delays, jeopardizing the fund's success. These examples illustrate the importance of clear negotiation and effective agreement on key points. Tailoring term sheets to specific scenarios and being mindful of potential pitfalls can pave the way for successful and mutually beneficial real estate investments. Common points of negotiation and potential pitfalls. Explanations. Negotiating the terms of a real estate term sheet involves a careful balance between the interests of investors, fund managers, and other stakeholders. This process aims to create a fair and comprehensive agreement that outlines the roles, responsibilities, and expectations of all parties involved. Let's delve into the explanations behind common points of negotiation and potential pitfalls. 1. Equity ownership. Explanation. Equity ownership determines the ownership stake each investor holds in the real estate venture. Negotiations involve determining how equity is distributed based on the amount of capital contributed by each investor. Potential pitfall. If equity ownership isn't clearly defined or if one party perceives inequitable distribution, disputes may arise that could jeopardize the working relationship and decision-making process. 2. Profit distribution. Explanation. Profit distribution outlines how the generated returns will be shared among investors and fund managers. It's crucial to determine the order of distribution, any preferred returns, and the split of profits among different stakeholders. Potential pitfall. A poorly structured profit distribution mechanism may lead to disagreements, mistrust, and conflicts over how profits are allocated. 3. Management fees. Explanation. Management fees compensate the fund manager for their services. The negotiation involves determining the fee structure, whether it's based on assets under management, a flat fee, or a combination. Potential pitfall. If management fees are too high, investors might feel that the fund manager's interests are misaligned with theirs. Conversely, fees that are too low might affect the fund manager's ability to provide quality services. 4. Investment period. Explanation. The investment period outlines the duration during which the fund will actively acquire, manage, and potentially sell properties. This period must align with the fund's strategy and objectives. Potential pitfall. If the investment period is overly long or short, it might lead to dissatisfaction among investors who have different investment horizons or expectations. 5. Exit strategy. Explanation. The exit strategy defines how and when investors can realize their returns, either through property sales, refinancing, or other means. Negotiations ensure that the chosen exit strategy aligns with investor preferences and market conditions. Potential pitfall. If the exit strategy isn't well defined or agreed upon, investors may face uncertainties about when they can expect to see returns on their investment. 6. Distributions and waterfall structures. Explanation. The distribution waterfall determines the sequence in which profits are distributed among different classes of investors. This structure ensures that all stakeholders receive their share of returns according to predetermined priorities. Potential pitfall. Complex waterfall structures can lead to confusion, disputes, and concerns about transparency and profit distribution. 7. Anti-dilution provisions. Explanation. Anti-dilution provisions protect early investors from dilution of their ownership stake in subsequent financing rounds. These provisions ensure that investors' ownership percentages are maintained if new shares are issued at a lower price. Potential pitfall. Overly aggressive anti-dilution provisions might discourage new investors from participating in future rounds, limiting the fund's ability to raise capital. 8. Reporting and communication. Explanation. Clear reporting and communication mechanisms keep investors informed about the fund's performance, operations, and financials. Negotiations define the frequency, format, and content of reports. Potential pitfall. Inadequate reporting can lead to investor uncertainty and decreased confidence in the fund's management, potentially affecting investor relations. 9. Restrictions and covenants. Explanation. Restrictions and covenants outline certain limitations or requirements related to property management, development, or use. Negotiating these terms ensures that the fund's objectives and investor interests are protected. Potential pitfall. Overly restrictive covenants can limit the fund's ability to adapt to changing market conditions or capitalize on new opportunities. 10. Dispute resolution. Explanation. Dispute resolution mechanisms define how conflicts will be resolved among stakeholders. These mechanisms can include arbitration, mediation, or other alternative methods to avoid costly litigation. Potential pitfall. A lack of clear dispute resolution mechanisms can lead to disagreements escalating into legal battles, impacting the fund's operations and reputation. 11. Regulatory compliance. Explanation. Regulatory compliance provisions ensure that the fund and its investments adhere to relevant legal frameworks. Negotiations involve addressing compliance requirements across jurisdictions. Potential pitfall. Ignoring regulatory compliance can lead to legal liabilities, fines, or even the dissolution of the fund if violations are severe. Negotiating these points requires open communication, a willingness to compromise, and a thorough understanding of the potential risks and benefits associated with each aspect. Addressing these common points of negotiation effectively can contribute to the success and stability of the real estate investment venture. Actionable advice. Navigating common points of negotiation and avoiding pitfalls. Negotiating the terms of a real estate term sheet is a complex process that requires careful consideration and a strategic approach. To help you navigate common points of negotiation and avoid potential pitfalls, here's actionable advice to ensure a successful outcome. 1. Clear communication. A-sense advice. Foster open and transparent communication with all stakeholders, including investors, fund managers, and legal experts. I-sense action. Clearly articulate your fund's objectives, strategies, and potential risks to all parties involved. Address concerns and expectations upfront. 2. Thorough due diligence. A-sense advice. Conduct thorough due diligence on investment opportunities and fund structures. I-sense action. Gather comprehensive data, financial projections, and market analyses to ensure the terms are based on realistic expectations and accurate information. 3. Seek expert guidance, sense advice, engage legal professionals, financial advisors, and experienced mentors. Sense action. Leverage the expertise of professionals who specialize in real estate investments to ensure that the term sheet aligns with industry best practices and legal requirements. 4. Balance flexibility, sense advice. Strike a balance between flexibility and specificity in terms to accommodate changing market conditions. Sense action. Craft provisions that provide room for adjustments while maintaining clarity on key terms, such as profit distribution and exit strategies. 5. Alignment of interests, sense advice. Ensure that the term sheet aligns the interests of all stakeholders. Sense action. Tailor terms to motivate performance, prioritizing mechanisms that reward positive outcomes while minimizing potential conflicts of interest. 6. Transparency in reporting, sense advice. Establish robust reporting mechanisms that provide investors with timely and accurate information. Sense action. Create clear guidelines for regular reporting, ensuring that investors are well informed about the fund's performance and activities. 7. Flexibility in exit strategies, sense advice. Design exit strategies that accommodate various market scenarios and investor preferences. Sense action. Include provisions that allow for adjustments in exit timing and methods based on changing market conditions. 8. Focus on long-term relationships, sense advice. Prioritize building long-term relationships with investors. Sense action. Structure terms that promote ongoing communication, trust, and alignment of interests to foster a positive and collaborative investment experience. 9. Mitigation of risks, sense advice. Identify and address potential risks and challenges in the term sheet. Sense action. Include provisions that outline how risks will be managed and mitigated to protect both investors and fund managers. 10. Continual learning, sense advice. Stay updated on industry trends and best practices. Sense action. Continuously educate yourself on evolving market dynamics, legal changes, and investor expectations to adapt term sheets accordingly. 11. Review by legal experts, sense advice. Have legal experts review the term sheet thoroughly. Sense action. Ensure that legal language is accurate and that all regulatory and compliance requirements are met to avoid potential legal disputes. By following these actionable steps, you can enhance your ability to navigate common points of negotiation successfully and avoid potential pitfalls when crafting real estate term sheets. Remember that a well-structured term sheet serves as the foundation for a strong and prosperous real estate investment venture. Maintaining transparent and open communication. Transparent and open communication is the bedrock of successful real estate investments. In the context of real estate funds, maintaining clear and ongoing communication with all stakeholders, including investors, fund managers, and partners, is essential for building trust, managing expectations, and ensuring the success of your investment venture. Here's how to effectively maintain transparent and open communication. 1. Regular updates, sense advice. Provide regular updates on fund performance, market trends, and key developments. Sense action. Send periodic reports, newsletters, and presentations to keep investors informed about the progress of the fund and any relevant industry insights. 2. Timely responses, sense advice. Respond promptly to inquiries and concerns from investors and stakeholders. Sense action. Address questions, requests, and feedback in a timely manner to demonstrate your commitment to transparency and collaboration. 3. Performance metrics, sense advice. Share detailed performance metrics and financial information with investors. Sense action. Present comprehensive reports on the fund's financial health, asset valuation, rental income, expenses, and returns to provide a complete picture of its performance. 4. Investor meetings, sense advice. Organize regular meetings with investors to discuss fund performance and outlook. Sense action. Conduct face-to-face or virtual meetings to foster direct interactions, address concerns, and share insights about the market and investment strategies. 5. Webinars and seminars, sense advice. Host educational webinars and seminars on real estate trends and investment strategies. Sense action. Share valuable knowledge and engage investors in discussions about industry updates, opportunities, and risks. 6. Clear reporting guidelines, sense advice. Establish clear guidelines for reporting expectations and formats. Sense action. Define the frequency, content, and delivery methods of reports, ensuring that investors know what to expect and when. 7. Transparent fund updates, sense advice. Communicate changes or developments that impact the fund's operations. Sense action. Share updates on property acquisitions, sales, refinancing, and other significant events that may affect the fund's performance. 8. Addressing challenges, sense advice. Communicate openly about challenges and risks the fund may face. I-Sense action. Discuss potential obstacles, market fluctuations, and risk management strategies to keep investors informed and reassured. 9. Two-way communication. I-Sense advice. Encourage feedback and suggestions from investors. I-Sense action. Create channels for investors to express their opinions, concerns, and ideas, fostering a collaborative environment. 10. Technology and transparency. Advice. Leverage technology to enhance communication and transparency. Action. Utilize investor portals, secure communication platforms, and data visualization tools to provide easy access to information. 11. Transparency policies. Advice. Establish clear transparency policies within the fund. Action. Outline guidelines for how information will be shared, the frequency of updates, and the process for handling sensitive data. Transparent and open communication is a fundamental aspect of maintaining positive relationships with investors and stakeholders. By embracing a culture of transparency, you demonstrate your commitment to their interests, building trust and credibility that can lead to long-term success in the real estate investment landscape. Relevant examples: maintaining transparent and open communication. Example 1, monthly investor updates. Scenario: OACView Real Estate Fund, a multi-asset CRE fund, understands the importance of transparent communication. They send out monthly investor updates to keep their investors informed and engaged. Action: OACView sends out detailed reports each month, including financial performance metrics, occupancy rates, property valuation updates, and market trends. They also host a monthly webinar where investors can directly ask questions and receive real-time responses from the fund managers. This regular communication has led to strong investor loyalty and confidence in the fund's operations. Example 2, quarterly property tours. Scenario: Crestline Property Fund specializes in value-add commercial properties. To ensure transparency, they offer quarterly property tours for their investors. Action: every quarter, Crestline organizes guided tours of their properties, both existing and recently acquired. This hands-on experience allows investors to see the progress of renovations and improvements firsthand. During these tours, fund managers provide insights into the strategies behind property enhancements and answer questions from investors. This approach not only builds transparency but also fosters a deeper understanding of the fund's operations. Example 3, Digital Investor Portal. Scenario: Bayshore Equity Partners, a private equity real estate firm, has a diverse portfolio of commercial properties. They prioritize transparent communication through technology. Action: Bayshore has developed a secure online investor portal where investors can access real-time updates on their investments. The portal provides detailed financial reports, property performance data, and market insights. Additionally, investors can submit questions and receive prompt responses from the fund managers through the portal's messaging system. This digital platform streamlines communication and enhances transparency for all stakeholders. Example 4, quarterly market outlook webinars. Scenario: Horizon Capital Fund focuses on core real estate investments. They recognize the value of sharing market insights with their investors. Action: Horizon Capital hosts quarterly webinars that not only cover the fund's performance but also include a segment on the current state of the real estate market. They invite industry experts to provide analysis on market trends, interest rate movements, and economic indicators. By providing broader industry knowledge, Horizon Capital strengthens its transparent communication approach and positions itself as an informed and reliable investment partner. Example 5, Annual Investor Retreat. Scenario: Riverside Real Estate Trust is known for its opportunistic investments in distressed properties. They prioritize face-to-face communication with their investors. Action: Riverside hosts an annual investor retreat where investors have the opportunity to meet the fund managers, visit properties, and engage in open discussions. The retreat includes presentations on the fund's strategies, historical performance, and plans for the future. This immersive experience creates a strong sense of trust and transparency, as investors can see firsthand the properties they have invested in and interact directly with the management team. These examples demonstrate how different real estate funds implement transparent and open communication strategies. Each approach is tailored to the fund's specific characteristics and investment strategies, fostering trust, engagement, and long-term success with their investors. Explanation: Maintaining transparent and open communication. Transparent and open communication is a cornerstone of successful commercial real estate, CRE, fund management. It involves sharing relevant information, updates, and insights with investors and stakeholders in a clear, honest, and timely manner. This practice fosters trust, enhances investor confidence, and ensures that all parties are well informed about the fund's operations, performance, and decision-making processes. Maintaining transparent and open communication requires a deliberate and proactive approach, which can be achieved through various strategies and methods. 1. Regular reporting and updates. Providing regular reports and updates on fund performance, property acquisitions, market trends, and financial results is crucial. Quarterly or monthly reports should include key metrics, such as occupancy rates, rental income, property valuations, and any changes to the fund's investment strategy. Clear and concise reporting helps investors stay informed about their investments and demonstrates the fund's commitment to transparency. 2. Scheduled investor meetings. Organizing periodic investor meetings, whether in person or virtual, allows fund managers to present updates and address investor questions. These meetings provide an opportunity for direct interaction and ensure that investors can voice their concerns or seek clarifications on various aspects of the fund. 3. Digital investor portals. Developing a secure online platform or investor portal where investors can access real-time information is a valuable tool for transparency. The portal can host financial reports, property data, market analyses, and other relevant documents. This digital approach enables investors to access information at their convenience and fosters transparency and data sharing. 4. Property tours and site visits. For funds with physical properties in their portfolio, conducting property tours or site visits for investors can offer a tangible experience. Investors can see the condition of properties, ongoing renovations, and strategies in action. This hands-on approach builds confidence and understanding while reinforcing the fund's commitment to openness. 5. Webinars and educational content. Hosting webinars on relevant topics, such as market trends, investment strategies, and property management, can educate investors and demonstrate the fund's expertise. These sessions encourage dialogue and provide a platform for addressing questions in real time. 6. Personalized communication. Tailoring communication to individual investor preferences and needs fosters a sense of personalized engagement. Providing access to fund managers or designated points of contact for direct communication enhances transparency and builds stronger relationships. 7. Addressing challenges and risks. Openly discussing challenges, risks, and potential setbacks with investors demonstrates the fund's willingness to address potential issues. Sharing plans for risk mitigation and contingency measures can help manage expectations and alleviate concerns. 8. Timely response to queries. Promptly responding to investor inquiries, whether through email, phone calls, or digital platforms, shows a commitment to accessibility and transparency. Clear and timely communication establishes a positive rapport between the fund management and investors. 9. Education and market insights. Providing investors with educational content and market insights beyond fund-specific information showcases the fund's industry expertise. This approach positions the fund as a knowledgeable partner invested in the success of its investors. By consistently implementing these strategies, CRE fund managers can create a culture of transparent and open communication that strengthens investor relationships, boosts confidence, and ultimately contributes to the long-term success of the fund. Actionable advice. Maintaining transparent and open communication. Maintaining transparent and open communication is essential for building trust, fostering investor confidence, and ensuring the success of your commercial real estate (CRE) fund. Here are actionable steps to effectively implement transparent communication practices. 1. Develop a communication strategy. Create a comprehensive communication strategy that outlines the frequency, channels, and types of communication you will use to engage with investors. This strategy should cover regular reports, updates, meetings, and any additional communication methods you plan to employ. 2. Set clear expectations. From the outset, set clear expectations regarding the frequency and format of communication. Let investors know when they can expect updates, reports, and meetings. Consistency is key to building trust. 3. Utilize digital platforms. Implement a secure online investor portal or platform where investors can access important documents, reports, and property information. Ensure this platform is user-friendly and provides real-time data. 4. Provide comprehensive reports. Prepare detailed quarterly or monthly reports that include key performance indicators, financial statements, property performance metrics, and market insights. Use graphs, charts, and visual aids to enhance clarity. 5. Organize investor meetings. Schedule regular investor meetings to present updates, discuss market trends, and address investor questions. These meetings can be in person or virtual, depending on investor preferences and the fund structure. 6. Personalized communication. Tailor communication to individual investors' preferences. Some investors may prefer detailed reports, while others might appreciate concise summaries. Make an effort to understand their communication preferences. 7. Be transparent about challenges. Communicate openly about challenges the fund is facing, potential risks, and how you plan to mitigate them. Providing solutions and demonstrating preparedness can build investor confidence. 8. Respond promptly. Respond promptly to investor inquiries and concerns. Even if you don't have immediate answers, Acknowledging their queries shows that you value their input and are committed to addressing their concerns. 9. Educational webinars and content. Offer webinars, seminars, or written content on topics relevant to your fund's strategy and the overall real estate market. This demonstrates your expertise and keeps investors informed. 10. Update investor relations team. Ensure your investor relations team is well equipped with up-to-date information to provide accurate responses to investor queries. Regularly train your team on communication best practices. 11. Highlight successes and milestones. Celebrate successes and milestones achieved by the fund. Sharing positive outcomes with investors reinforces their decision to invest and fosters a sense of collective achievement. 12. Gather feedback. Seek feedback from investors on your communication efforts. This can help you identify areas for improvement and tailor your approach based on their preferences. 13. Be transparent about changes. If there are any changes to the fund's strategy, investment focus, or key team members, communicate these changes transparently to investors. Explain the rationale behind the changes and how they align with the fund's goals. 14. Continuous improvement. Regularly review your communication strategy and seek ways to improve. Stay open to adopting new tools, technologies, and methods to enhance communication efficiency. Transparent and open communication builds strong investor relationships, enhances credibility, and creates a sense of partnership between the fund management and investors. By consistently following these actionable steps, you can establish a reputation for transparency and set your CRE fund on a path to success. Conclusion. Navigating Due Diligence and Negotiations. Chapter 7 has explored the intricate world of due diligence and negotiations in the context of commercial real estate, CRE, investments. From conducting thorough due diligence on investment opportunities to navigating the complexities of negotiation, this chapter has provided valuable insights and strategies to help CRE professionals make informed decisions and achieve favorable outcomes. Effective due diligence is the foundation of successful CRE investments. It involves comprehensive research, analysis, and assessment of various aspects, such as financials, legal matters, market trends, and property conditions. By diligently investigating every detail, investors can uncover potential risks, opportunities, and align investments with their objectives. The relevant examples, explanations, and actionable advice in this chapter have illuminated the critical steps and best practices needed to conduct due diligence effectively. Negotiations play a pivotal role in shaping the terms of an investment. Understanding common negotiation points, potential pitfalls, and maintaining open communication are key elements of a successful negotiation process. Through the provided examples, explanations, and actionable advice, readers have gained valuable insights into how to navigate negotiations, ensure alignment of interests, and create win-win solutions for all parties involved. As this chapter concludes, it's important to emphasize the significance of due diligence and negotiation in the CRE industry. Both processes require attention to detail, patience, and a commitment to transparency. By mastering these aspects, CRE professionals can navigate the complex landscape of investments, build robust portfolios, and achieve sustainable success. The skills acquired through this chapter are not only essential for seasoned investors but also for those who are just starting their journey in the CRE sector. Armed with a deep understanding of due diligence and negotiation principles, individuals can confidently approach investment opportunities, make informed decisions, and contribute to the growth and prosperity of the real estate industry. In the next chapter, we will delve into another crucial aspect of commercial real estate investments, the art of constructing effective term sheets that outline the terms, conditions, and expectations of a deal. Key points to remember. Chapter 7, Due Diligence and Negotiations. Chapter 7 has provided a comprehensive overview of due diligence and negotiations in the realm of commercial real estate, CRE, investments. Here are the key points to remember from this chapter. 1. Importance of due diligence. Sense due diligence is a thorough investigation and assessment of investment opportunities before making decisions. Sense it involves analyzing financials, legal documents, property conditions, market trends, and potential risks. Sense proper due diligence minimizes uncertainties and enhances informed decision-making. 2. Steps in conducting due diligence. Sense research the property's history, ownership, and market conditions. Sense review financial statements, including income, expenses, and projections. Sense assess legal documentation, leases, permits, and potential legal issues. Sense evaluate property conditions, maintenance needs, and potential renovation costs. Sense analyze market trends, demographics, and demand drivers. 3. Negotiation essentials. Sense negotiation is a process of discussing and reaching agreements on terms, conditions, and expectations. Sense identify common points of negotiation, such as pricing, financing, terms, and contingencies. Sense maintain open and transparent communication with all parties involved. 4. Maintaining alignment of interests. A-sense balance the interests of investors, partners, and stakeholders for mutual benefit. I-sense create win-win solutions by addressing concerns and finding common ground. A-sense design term sheets that prioritize shared goals and long-term collaboration. 5. Transparency and communication. A-sense open communication builds trust and enhances the negotiation process. A-sense keep all parties informed about progress, changes, and developments. I-sense address potential disputes proactively and seek solutions together. 6. Understanding potential pitfalls. A-sense be aware of common pitfalls in negotiations, such as unrealistic expectations or lack of information. A-sense anticipate challenges and prepare strategies to overcome them. 7. Value of win-win solutions. A-sense negotiating for win-win outcomes fosters positive relationships and promotes repeat business. A-sense tailor solutions to meet the needs and objectives of all parties involved. 8. Legal and regulatory compliance. A-sense ensure that all due diligence and negotiation activities align with legal and regulatory requirements. A-sense work with legal experts to navigate complex legal aspects. 9. Informed decision-making. A-sense comprehensive due diligence empowers investors to make informed investment decisions. A-sense effective negotiation skills lead to favorable terms and successful deals. 10. Long-term implications. A-sense due diligence and negotiations impact the long-term success of investments and relationships. A-sense diligent research and thoughtful negotiations contribute to minimizing risks and maximizing returns. By internalizing these key points, CRE professionals can navigate the due diligence and negotiation processes with confidence and proficiency. Armed with a strong understanding of these principles, investors can forge successful deals, foster positive relationships, and contribute to the growth of the commercial real estate industry.